It's been a bittersweet journey getting here, and it seems that when it rains, it really does pour. If you watch my videos and you're inspired about personal finance and money and dividends and Robinhood, today I apologize to you because I can no longer play the long game. Today something has to happen that hasn't happened since before I started investing my money in the stock market many years ago. Whew, it is here! Final Fantasy VII. I cannot believe it. Goodbye, YouTube. Hello, childhood. But today's video is not about chocobos and moogles. Yes, I am a child and I own a moogle, because today's video is more about investing in the stock market, and that is selling my stocks, something that I really don't like doing. I can already tell that in the year 2020, I've already lost a couple $100 in annual dividend passive income from dividend cuts already. Don't mind me. That's just my passive income burning away. Except dividends are what gives me the confidence to be an investor in the stock market in the first place, because that's how I'm going to retire. And without all that, all I have are just digits on a phone screen moving up and down. So today I want to share with you exactly when might be a good time to sell, which stocks and why I'm selling them, and why you may want to consider selling as well. Let's begin. Hi everyone, my name is Andrei Jikh. Hope you had a wonderful weekend, but I suppose every day is now a weekend for over 16 million Americans and counting, including myself. High five, Gypsy. JP Morgan just recently announced that they're only loaning money out to people who have a credit score of 700 and above, and those who could put down 20% or more. And this will exclude a ton of people, because 20% down payment is a lot of money to a lot of people. And this, ladies and gentlemen, is how the housing crisis will begin. Because if all the other lenders follow suit, it's gonna be so difficult to buy a house. Because even if housing prices fall, even if interest rates go lower than they are today, none of those things will matter, because it's going to be so hard to be able to borrow money in the first place. That's why I said having a great credit score is like playing a video game long term, and you just have to beat this video game, because when opportunities will present themselves to you, like I think they're about to, then at least you'll be ready to borrow some cheap money. On top of that though, analysts are saying that we're gonna see another 40% drop in the economy, and in April, the second quarter of this year, we're gonna see another 30% decline, with 25 million people filing for unemployment in April alone. But underneath the facade, the fundamentals of a company don't really lie. So if we pop open the hood just to see exactly what's underneath, in order to determine which stocks we may wanna buy, sell, or keep, here are some things you might want to keep track of. These are things like EPS, which is the earnings per share, the free cash flow, the EPR, which is earnings payout ratio, the sales growth, and the ROE, return on equity, the dividend yield, and the dividend safety score, and the history and the commitment that the company has to paying its shareholders dividends to begin with. So as soon as they cut their dividend, stock prices tend to fall really hard. And this actually just happened recently to me with a few of the stocks that I own in my portfolio here on the side with Robinhood.
You're still promoting that platform? He's just a paid shill for Robinhood.
No, actually I still use Robinhood just because I'm a boring long-term dividend investor. I don't trade options, I don't do day trading, but if you want those features, then yes, Robinhood is probably not the best broker to use. Use something like M1 Finance, Webull, Fidelity, Charles Schwab, Vanguard, use anything you want. I have zero allegiance to Robinhood or any other broker. I haven't sold out just yet, but I reserve the right to in the future. But now things are starting to look a lot worse, and some of the companies that I hold in my portfolio are quickly becoming liabilities and are becoming a greater risk of cutting their dividend. And the idea for us is to basically get ahead of those dividend cuts before they happen, so that we don't lose even more money holding that stock and that passive income when they inevitably announce that they've decreased or have gotten rid of their dividend altogether. But at the end of the day, I'm still going to be a long-term investor, because I can't predict the future, other than give a call back to one of my last videos and say things are gonna go lower based on this coin flip. I'm a genius. Number 1, CLDT, Chatham Lodging Trust, and it is a REIT. Now I love REITs, but unfortunately for them, they are by law required to pay back 90% of the money they make back to their shareholders, and that makes it particularly difficult for them because they own 134 hotels, which no one is staying at because of the situation that we're in right now. It's almost like when you used to play Monopoly when you were a little kid, and then you would own all of the hotels, but then you would draw that one card. No! So I'd rather put my money somewhere safer, and based on my yield on cost of 6.67%, I will have lost $211 of an annual income. Bye, Felicia. This nets me a loss of a little over $2,000, which definitely hurts. The second company we're gonna be taking a look at selling is ticker symbol GPS, George St. Pierre. He's just not what he used to be, that old baguette. No, I'm kidding. GPS stands for Gap, and they've had an unhealthy 112% earnings per payout ratio in the last 12 months. That means they literally paid more money to their shareholders than they made in the entire year. And the only way to do that is by taking cash from your cash reserves or using debt to pay shareholders, like some of the energy companies are doing right now. Also, their sales growth numbers are down by 1%, and ideally you don't want to own a stock whose sales growth numbers are shrinking, because that means their business is getting smaller and smaller year over year as less and less people are actually going out to buy their brand. So I'm gonna sell 50 shares of Gap, which will represent a $48 annual income loss. But the moment that I actually go and sell and realize a loss, that's when it becomes a real loss. Hence, realized loss, because I realized I lost money. But that's okay, because we can make these $4 maybe worth a little bit more. Because I haven't done this one in a while. Let's see what we can do. Ah, sweet, 400. I'm $100 short though. Got a dollar? And the third stock that has cut its dividend for me is PEBBLEBROOK Trust Hotel. Now again, that's another REIT, so similar reasons to CLDT, Chatham Lodging Trust. REITs are just getting crushed, and the forecast is that this company will probably not be very profitable in the next 3 years, so I don't want to hold something that is going to continue to slide in value while it can't even afford to pay me dividend income. It's also underperformed the REIT market as a whole, losing me 63.7% in comparison to the US REIT market, which has only lost 11% during the same time. So a huge difference, big numbers, and this has cost me $880.80, or when converted to an annual income, I will have lost $91.20. So that's what I've sold, or what I'm planning to sell very soon. And by doing this, I've broken Warren Buffett's cardinal rule of investing. Rule number 1, don't ever lose money. And rule number 2, don't forget about rule number 1. But that's okay, I don't feel too bad, because Warren Buffett kind of broke his own rule too.
I told you.
No, Warren, you didn't tell me. How could you? That's because he didn't know, so he also took pretty large substantial losses. That's okay, because to err is human, but to live to 89 is divine. I don't know. But I'm also going to be selling the following stocks that have an unsafe dividend score. It's a really cool system that combines a ton of different metrics for one single score rated from 0 to 99. Anything closest to 0 is considered unsafe and it can cut its dividend, and anything closest to 99 means it's very safe. So for example, if you're wondering whether or not you should invest in a stock like Carnival Cruise Line, then maybe you would have looked at the dividend safety score and saw that it was only 35, which is considered unsafe, and maybe then you would have known not to buy the stock like I did, and then that way you would have saved a ton of money when it inevitably cut its dividend, because I thought, nah, that's a sinking ship. Sometimes you just have to learn how to cut your losses and move on. And at number 4 is SKT, or TANGER Factory Outlet Centers. Guess what sector they're from? If you guessed REIT, you guessed right. Now, REITs in general are very cyclical, but especially this REIT, which is a chain of malls. And malls in general are doing pretty bad right now, especially considering no one can visit them. And this dividend safety score is the lowest in my entire portfolio at 20, which is considered very unsafe. So by selling it, I will lose $36 of an annual income, and I am down 65% on that stock. And next up at number 5 is BP. And this is an oil company. And since I pretty much own all of of the oil giants, I think that after this whole disaster is over, there'll maybe be 3 to 4 giant oil companies left. I could see Chevron, ExxonMobil, Shell Oil, and maybe 1 or 2 more left standing after this whole crisis is over, because it's going to be very difficult for them to survive. And I think BP's balance sheet is looking extremely fragile lately, and I don't need any more exposure to oil and the energy sector anyway. And with a safety score of only 30, that means their dividend is very unsafe, because they have a payout ratio of, get this, 413%. That means they pay well in excess of 4 times what they actually make. And that means, how many times can I use it in one video? Leave your guesses down below. Still though, this represents a pretty big loss for me at $173.25 annually. And coming in at number 6 is CZNC, which is Citizens and Northern, which is a bank that has also failed to grow its dividend last year, and their EPS, or earnings per share, has pretty much stayed flat in the last 5 years, and the company has also diluted shares, which means a company will introduce a bunch of new shares to the stock market, thereby lowering the percent that I own in the company, which is never really a good thing to do. Their dividend is on shaky ground, so overall I'd say this company is just, And they've also cut their dividend before, so that means not the greatest track record for shareholders like myself. So this sale represents a loss of $65 per year. And coming in at number 7 is DINE Brands Global. These guys own Applebee's and IHOP, which I love both of them. And I'm not selling the stock because I think they're going away in the future, and their balance sheet is actually not the worst on this entire list. They have an earnings payout ratio of below 50%, which is good. They have an operating margin above 16%, which is good for restaurants. They have a sales growth of 17% in the last 2 years, but their dividend safety score is only 33, and they've cut their dividend in the last recession in 2008, and I think there's a really good chance that it might happen again if this recession is even worse. And overall, I think restaurants are a pretty risky play right now, so I'd rather protect my income, and selling this stock will lose me $76.41 in annual income. And at number 8 is HBI, or Hanes Brands. If you remember, look who we have our Hanes on now, that whole campaign. I'm gonna get my Hanes off of this one though, because even though I don't have anything terribly bad or terribly great to say about it, it's kind of a toss-up. The only bad thing I have to say about this one is that they have a pretty large amount of debt in relation to their size at $3.4 billion. So for now, I want to be extra safe and just take my precautions. Their safety score is 36, which is considered unsafe. So by selling this, I'm going to lose $12 in annual income. But at least there is one silver lining from all of these stock losses, because I can use tax loss harvesting to write off up to $3,000 of my annual income, and then whatever's in excess of that, I can just roll it over into the next year. So now that I've done all that and plugged in some stuff into my spreadsheet, I've removed some of the stock positions, and I can see exactly how much of an income I've lost. And I have lost $712, which represents roughly 10% of my annual income. And I think that is pretty substantial, because if I lost 10% of my annual income in retirement, that might make or break the difference between me being able to eat and feed myself and pay my rent and not being able to at all. But remember, this is actually not super accurate either, because I've counted everything, both my stock sales and my dividend cuts. But I shouldn't count my stock sales, because I got money for that, and that money I'm going to use to reinvest and get more of an annual income increased into that 10%. So if I was to really be specific and fair to myself, I would only count the dividend cuts. And the dividend cuts represent $350, which is closer to 5% of my annual income. And 5%, if I was to get rid of that in retirement, I think I could live pretty much the same without being affected too much. And I think that's not bad, considering that we just had one of the worst stock drops in history. To lose 5%, I'm pretty happy with that, but I still want to stay ahead of the curve in case the situation gets even worse. Remember, if you miss the top 10 days of the stock market, you will seriously regret it. Now, when investing, you might have heard the saying, it's not about timing the market, it's about time in the market. And it's very true, because I've seen these research studies and they all conclude that if you miss the top 10 days because you got scared and you wanted to sit and wait it out, you will have lost a potential profit of 50%. So for example, just like recently, we've had some crazy moves down, right? But then within a matter of 2 weeks, just like the studies show, we had a couple days that had a 10% move upward. Well, 2 days represent 20% recovery. 20% represents 2 to 3 years of good stock market growth. And when you take that 20% and you compound that over 10, 20, 30-year periods, and that is a massive, massive difference. And if you miss 30 days of the best trading days in the stock market because you decided to sit it out for a couple months, then you will have lost entire profit over a 20-year given period. That's just insane. And I hope that makes sense why I don't just sell my entire stock portfolio while I'm still in the green, because that honestly scares me a lot more than seeing my money drop. That's why I want to remain in the market for better or for worse rather than try to time it. Whenever I buy a company, I don't try to speculate what's going to happen in the short term. I don't try to get ahead of earnings to try to make a quick buck. Instead, the mentality I have is whenever I buy a new stock, I treat it like I'm making a lifelong friend for the first time. And having this kind of mentality allows me to get ahead of myself emotionally and not just throw friendships away over a few ups and downs. That's a good pun, I like that. Unless they side with Carol Baskin. Just kidding. I'm just trying to stay culturally relevant. Can you imagine trying to sell that show on Netflix? What does that even sound like? I have this show idea for a bunch of white people trying to sell tigers, and then it takes a darker turn and it turns out to be about corruption, power, greed, and money? Who's the hero? No one? Sold! I imagine it went down just like that. Crazy times that we live in. Hope you stay safe, enjoy the rest of your week, get your 2 free stocks with your Webull account by funding it $100, one of which could be valued up to $1,400. Get your other free stock with Robinhood. Follow me on the Instagrams. Love you all, and I'll see you very soon. Bye-bye.